Cash now, financial runway. And I want to focus on Lilium and vertical airspace because they may run out of cash in the next quarter. So always options to aggressively raise cash is to dilute existing shareholders, do a share offering, and what have you. But they both are at a price that stock price that's nearly $1. So it's going to be very, very, very difficult for them. I mean, there is no catalyst that will take the price up for them to do a share offering. It's a cash 22 for both of them. So they are somewhat similar in the sense that their business model is simple. They want to be an aircraft OEM. They want to fabricate, manufacture aircraft, sell them, service them in the aftermarket. And I like that simplicity in the business model. Where they're different is that Lilium founders have an aerospace or aeronautic background. Thomas Enders is the chairman of the board. He was the CEO of Airbus. You mentioned Klaus, who was the above A320 program. On the opposite side, vertical aerospace, the founder has a business background, right? A finance person. He owned an energy provider company, Formula One racing team. And so he doesn't have, it's fair to say, he doesn't have personally a background in aerospace, but they're both struggling, right? A Monday morning quarterback will tell you, well, if only he had an aerospace background, or if only they had a business background. Both of them have a similar business model. They're in the same continent, if you would, but they're both struggling. So what did they miss, Sergio, in your opinion?
Well, I mean, the at the very bottom is making airplanes cost a lot of money, and this is the part is you might have underestimated how much it costs. You might have grown too quickly. Your organization. There is many different explanations of why the cash runway is very short. I would say rather than trying to look for signs of this diseases, let's try to figure out how to cure it. And the truth is that while Lilium is burning at a higher rate than vertical, both companies are at this point where if you start slowing down the development to use less cash, you're also putting that point of revenue farther and farther out in the future. So it's a catch-22. It's a little bit of the solution that if you wait long enough, a problem will go away. 99 out of 100, it doesn't. I think that that's an important piece of the pie. I think another distinction is the fact that Lilium has access to this PDP, this pre-delivery payment, because they have decided to sell the first 50 airplanes to private people. And therefore, the structure of payments or down payments is different than with a large business-to-business transaction. And so that is something that instead it's a little bit different with vertical. Like, for example, if you were to go through the news, you will see that in the past, they announced that American Airlines had put a deposit for some of the airplanes. That deposit is pending an agreement that was supposed to be signed last July and has still not been signed. And therefore, the money does not exist yet. So it is something that needs to be taken into account.
Do you see a consolidation for these two, like a takeover, not consolidation?
So I think you make a great point, and I think it's something that we don't talk enough, right? When we talk about consolidation, I think the majority of people are expecting company to fail and disappear. However, and again, it's not a bad idea, considering that most of these companies are developing what we call perfect substitutes, right? So what is this and that? I mean, they're the same vehicles, more or less. So that complicates facts. However, there is a lot of legacy players that have not decided yet what they want to do in this market, and they might consider a fire sale of one of these companies at a certain point. And again, when I say one of these company, can be any company, because as you know, everyone's going to run out of money. It just depends when they're going to run out of money. And this is the other part. It doesn't matter when you're going to run out of money. It's when you're going to run out of money. When you compare it to when you're going to start making money, that matters. And so I think that consolidation from a point of view of acquisition, it's definitely something that I would be on the lookout for.
To develop an aircraft, you need a lot of money at the first place, and long-term financial commitment is also extremely important.
And I think the other part is we always wave around this figure of $1 billion. That is, it's a little bit like saying, the distance between here and another city is 300 miles. Then when you start going on the road and the traffic and everything, those 300 miles can become 400 miles. And so it's the same thing here. This $1 billion is just an indication of what it could be. And then it's very much dependent on your capital efficiency, your configurations, where you are located, and a lot of other factors that takes you to the fact that really the number varies significantly between 500-600 million and almost 2 billion. It really depends on your strategy. And as you mentioned, also vertical integration is another piece to take into consideration on how much money you need.
Talking about new aircraft development, how much money you need, let's address ehang. So ehang generates revenue now. They're selling EH216, $300,000, not a big amount, but still, they generate revenue. In the last earnings call, the CEO announced that they will be applying for a type certificate for the VT30. Looking at their cash position, end of year 2023, they were around $45 million. Where will they bring the money to develop a VT30?
So the VT30, it's not competitors to the Joby and the Archer at all. It's a two-seater autonomous airplane. So it's exactly like the 216. It's just that it has a wing. And so it has a longer range and a higher endurance. So number one, to start there. Number two, and I think that this is the part that I think in the West we do not pay enough attention. To certify a vehicle in China, it costs between 1/5 and 1/8 the cost of the United States. So you don't need $1 billion to certify an airplane in China. You need maybe 200, 250 million in the worst case. And many times you probably can get by with 100 million. So this is one thing that we need to be very aware of. And it is supported by two things. Number one, the cost of talent is significantly lower. By probably 70-80%, especially if you're talking about Silicon Valley. And the second part that you have to consider is the fact that as the factory of the world, they can make anything on any VTOL cheaper than we can do in the US. And you don't have to invent the wheel. There's motors, there's batteries, there's companies that make composites. Everything is there available that you can take advantage. And so as a result, even the cost of these vehicles is significantly lower. So if you take the EH216, the price outside China is the low 400,000. That's the cost of the fuselage, or just the fuselage on one of the airplanes. And again, and the other part that I also would put some attention is that last year they delivered 52 airplanes, and they have a facility that can make 600. And I would believe that those 600, the production capacity is going to be available much quicker than anyone in the West can make 600 of anything.